Hello, everyone. Welcome to the IVoT Investment Insights. I'm your host, Andrew Tang, and I want to go over three things with you this week. Now, just a reminder that the content of this video is for educational and informational purpose only, so full disclosure will be displayed at the end of the video. So please do watch to the end to access that information. So let's get started. So the first thing I want to talk about is that the consumers are nervous about losing their jobs, and that includes those that are making about 100,000 plus. So what does that mean? Well, one of the data that came out reflect this is the June's consumer confidence report. And for June, this month, it came in a little bit weaker, according to the conference board. What that shows is that consumers persistently concerned about the future and continue to wait on the confidence. Now, this index dipped in June to 100.4, and back in 1985, it's 100, and it's down from 101.3 back in May. The consumer confidence really reflects that hesitancy of this index, which it showcased that these consumers are being cautious, right? And that spans from across the board, whether you're in the service sector or you're in the white-collar office jobs and so on and so forth. Now, what's more important is looking at the expectations index. Now, we can see it in this chart here. Now, based on the consumer's short-term outlook for income, business, and labor conditions, it fell to 73% in June, down from 74.9 in May. I know it's not a huge move in terms of numbers movement, but this index has been low, below 80. That's the threshold that usually signals a recession ahead. And that has been the case for 5 consecutive months. So it does show that the consumers are nervous. People are afraid to losing their jobs. So outside of the extraordinary circumstances and another factor of COVID-19, outside of the COVID-19 pandemic, there's another data that we do look at, and that's the U.S. household savings rate. And it sits at about 3.6%, and it is higher than normal. And it does suggest that a shift in consumer behavior towards more conservative financial practices, like spending down, cutting back on the discretionary spending. And typically, post-financial crisis 2008, the savings rate in the U.S. usually hovers around 2 to 3%, but it had begun increasing gradually before the pandemic. So this uptick reflects the broader economic concern about uncertainty in the jobs market, inflation, and future prospect. Now, we know the expansion of this AI effort, and we've been hearing the term AI has been shoehorned to most of the conversations that you have heard, including the CEO's comments on companies' earnings. And it seems to be that the push for AI will take some time for it to be realized, but ultimately what it does is that it's going to push companies to become more efficient operators. And that comes in addition to the amazing discovery with large language models on how it solves problems and new tasks and new abilities and so on and so forth. And that will translate to great new innovations and tech, but at the same time, this push for efficiency is going to cause the companies to reduce their workforce through automation, through robotics, and whatever the case that may be. We see that happening down the road. So studies have shown that 70% of the earners making over $100,000, that they're afraid of losing their jobs. And that's a scenario that eventually will lead to slower spending. And we're already seeing that. Now, the second thing I want to talk about is for those who are familiar with the stocks and bond market, we are seeing the bond traders are taking a strong positions by anticipating the Federal Reserve will cut interest rate by a total of 3%. So that's 300 basis points by March of next year, according to Bloomberg. Now, this translates to Federal Reserve or the Fed funds rate down to as low as 2.25 to 2.5% by March of next year. And this magnitude of rate cut is beyond our base case scenario, and it is quite a bold bet. And it does reflect the expectations of significant monetary policies in effort to ease the pressure that has been pushing on financial markets since 2022, where the Fed funds rate have in the U.S. have increased from 0.5%, 0.5% to 5.5%. So that is a huge move in a very, very short amount of time. The good news is that we do expect the Federal Reserve to start lowering rates. We expect at least 2 rate cuts. It didn't happen in June, but we believe it's going to happen sometime in September. It could be as late as, towards the end of the year. But this is a very much a welcoming sign. We saw last week that Bank of Canada and the ECB have basically cut the ribbon on lowering rates, beating the U.S. to the punch. And we do see that the investors and consumers, they are starting to believe that the Fed is going to cut rates later on this year. So the base case, 2 cuts this year and carrying into next year, we believe that the Fed funds rate will settle around 3.5%. But the traders are betting a little bit more aggressively than our thinking. So at the end of the day, what does that mean? It means that currently bonds will be doing well, for the near-term future, okay, in addition to stocks, for long-term outlook. So the cost of capital will start to come down, and that will serve as a release valve with all this, higher for longer scenario. And I'll be back to talk a little bit more about it, but that is the second thing that I do want to highlight. Now, the third thing that has to do with healthcare and technology. And for the last 2 years, healthcare hasn't really been, been the focus of investors. It hasn't performed well compared to the Magnificent Seven or Magnificent Six, if you will. Largely have been led by NVIDIA with this AI revolution that is taking place. Now, this one area, it talks about healthcare, life science, biotech, and it's in the area of precision medicine. And this particular piece, it says that big data aggregation is paving the way for precision oncology. So last week, a very important paper that's been published on the study of cancer. The findings from 100,000 genomic projects were published with a whole genome sequencing, GWS, of 10,470 patients across 35 cancer types, identified 330 driver genes, including 74 previously unknown. Now, this study found that actionable mutations in 55% of the tumor, a significant improvement over the 22 publicly identified by the current testing method. These advances underscore the critical role of big data, including multi-omic and multi-model data, alongside with artificial intelligence enhancing precision oncology. But the decreased cost of AI, as we would expect, as cost of AI and the cost of training artificial intelligence starts to come down, these technologies will be much, much more available and applicable in the life science space. And this particular, these technologies are set to accelerate drug discovery and to develop a new cancer treatment by identifying more targetable drivers genes. So a lot more details can be observed, if you go to ARK Invest Big Idea 2024, and we will set up the link below for you to get access to that piece. And I think, ARK Invest, an amazing research house, have done an amazing job to deliver and to highlight, what are the big ideas, what are the really disruptive technologies and innovations that we can expect in 2024. It's too much to cover, but that's all the time we have for today. And I hope you enjoyed this week's commentary. And if there's any other topics that you'd like us to cover, please, just comment below. And if you like this video, please hit the like button. And, I would be more than happy to have you subscribe to this weekly commentary. So see you next week.